I am Troy McGuire, co-founder of FinTech TV, and Taking Stock starts now.
Two minutes to go here until the close. All of the major market indexes, with the notable exception of the New York Stock Exchange Composite Index, will finish this very volatile week slightly to the downside, though the NYSE Composite will finish up. Peter Tuchman, come on in here. What are you seeing? Very low volume right now. We do have volume confirmation, at least up volume relative to down volume, but we turned negative here in the last few minutes.
Yeah, you know what? We've been for sale all day. We've had $2 billion for sale, so there's not a problem with volume. Okay. The volume is on the downside. I don't know how it's going to end up, advanced versus declines, but I thought it was a nice relief rally, but you know, and it felt like we were going in the right direction, but it just felt like that the buyers got tired. Right, it is a Friday, and so whether it's profit taking coming out of a very, like a hard week, you know, I think anybody who's either trading this market or investing in this market is looking at this market and going like, where are we going from here? This is it's been tiresome. You know, I'm tired, right? And I've been trading it all week, but we had huge volume. We posted out, we've had $2 billion for sale all afternoon, and that was a big contributing factor to that rollover that you see in the SPY, right? I mean, and that's where we're going. You know, it's like, people don't want to go home long, right? Because, you know, we have a 3-day weekend. When you have a 3-day weekend, anything can happen in this world, right? We're one tweet away from crazy town, right?
Yep.
That's how I leave it.
We'll see what the weekend brings. You did an amazing job this week. I hope you enjoy the day off Monday for President's Day. We'll talk to you again soon
Take
next
a couple
week.
days off.
Yeah, you absolutely earned it. All right, the team from Iris will be on the broadcast. They're also here to ring the closing bell. We'll pick up our market coverage after this. Time now for the close. And there you have it. After a wild, volatile, use your adjective of choice here to describe what exactly happened across the major market indexes the last 5 days. Your final tail of the tape on this Friday the 13th. I didn't even lead off with that. With the S&P 500, wow, look at this little reversal. Had been negative into the closing auction the last 5 minutes. Now we'll eke out a 0.05% gain. The Dow will hold on to a fractional gain, up 0.1. The NYSE Composite Index, the only of the indexes up for the week, up about 0.6, and the small caps, the best of the bunch on this Friday the 13th, up 1.1%. Also catching a bid on the day, fintech stocks, healthcare, and biotech. The home builders having a strong day as yields fell across the board. Those shares led by Toll Brothers. AI software continues to bounce its way back, and industrials led by Caterpillar. Caterpillar continues to be, much like in 2025, the strongest performing name in the Dow. Let's bring in our first guest. He joins us remote. This is Brian Jacobson, Chief Economic Strategist at Annex Wealth Management. Brian, a very happy Friday the 13th. Thank you for being here to kick off this edition of Taking Stock. Tell me what you are seeing in the markets. Not quite at all-time highs, but Brian, despite the uncertainty, we're not very far off.
No, we're not. We're pretty close to those all-time highs. And if we look at what happened to the Dow, everybody got excited with it breaking above 50,000 earlier. But that can be a lot like if you have an old car and you see the odometer trip over to 100,000. It's exciting at the time, but then you just move on to the next milestone. And I think that's what this market is really trying to do, is saying, okay, what's next? We think that this rotation that we've seen from the large cap growth area to a little bit more diverse, smaller, mid cap across multiple sectors, that has me excited, especially since, to be perfectly honest, the last couple of years, I wasn't overweight large cap growth. I had an equal weight, and so it's kind of nice to see those areas that I had been overweight begin to catch a bid.
So, Brian, you love a rotation for a day like today, because telecom and discretionary financials, those are the three worst performing sectors, but your outperformers, talking about rotation, utilities, real estate, healthcare, sounds to me like that's the type of rotation and maybe a bit more defensive trade that you like on a day like today.
It really is. It's a little bit more defensive, but I think it's actually more the interest rate sensitivity of a lot of those. Healthcare in a midterm election year does tend to be one of the best years for healthcare stocks. It's just one of those historical consistencies. Maybe it's a little bit of a defensive trade. But when we say real estate and utilities doing well, look at the move lower that we had in the 10-year Treasury yield. With that inflation number that we had coming in softer than expected, that really helped push that 10-year Treasury down towards 4%. 4.05%. We haven't seen that in quite a while. And so with the interest rate sensitivity of utilities and real estate, not too surprising to see the big bounce there.
Yeah, the 10-year falling to its lowest level going back to December 1st. Might not seem like a long time frame in the scheme of things, but given how volatile yields have been, it's actually pretty notable to continue to see some rotation into fixed income instruments. Can I get your reaction to the CPI report? Softer than expected. Not a huge pop, I'd argue, from investor reaction, but this was a big print, Brian, the street was eagerly anticipating.
Yeah, when we look at that inflation number, the fact that it was 2.4% year over year, but the core 2.5% takes us back to March 2021. So we haven't been at that level since then. And I think that's really encouraging. You know, coming way off of the highs printed back in 2022, and it's been this choppy ride lower, doesn't mean now that we can actually get 2%, the Fed's target, sometime this year. I think that's back on the table, has people a little bit encouraged. So it puts us in a position where the Fed doesn't necessarily need to cut, because we did get that good jobs number earlier in the week, but that they can cut. It's not that they're being forced to cut because we're going into a recession. It's that we're actually inching closer to their target, allowing them to cut.
Yeah, I was reading the latest from Pantheon Research. They expect 3 interest rate cuts at 25 basis point each, totaling 0.75% reduction in the federal funds rate. Is that your expectation for the Fed? Take the holistic year-out view. How many cuts are you expecting?
Yeah, I personally still think that it's going to be 2 cuts, only because they're probably going to wait to see whether or not the numbers from January, the decent jobs number, and now this inflation number, does it actually stick? They're probably going to want at least 2 more cuts. And I think that really then does put, or 2 more meetings before they actually do make a decision. So that would put us at June. And then they probably don't need to like break glass in case of fire with anything. And as a result, they can go at a rather moderate pace and think about a June cut and then again in December.
Brian, I got less than a minute left. Any other big catalysts that you'll be paying attention to? Obviously, NVIDIA earnings coming out the 28th. That's a big one for market participants. What else is on your radar?
Yeah, that's probably the biggest, but otherwise we do have the GDP number. You know, the Q4 number coming out of the Atlanta Fed is saying that it could be, 4 to 5%. Is that actual reflective of the reality for the print that we're going to be getting next week? And maybe that's a little bit optimistic to think that we could see a 5 handle on it, but it's not outside of the realm of possibility, especially given the jobs number that we just got earlier this week.
We had a few of those Atlanta Fed GDP prints, 4.1, 4.2%. Strong outperformance to the upside. We'll Q4 number next Friday, 7 days from now. I could do math. Brian Jacobson, Chief Economic Strategist at Annex Wealth Management. Thanks for kicking off Taking Stock. Come back anytime. Good to have you.
My pleasure. Thank you.
All right. You got it, my man. Have a good long weekend. We will head this way. I'll bring you the latest. Excuse me, folks. What's up, Josh? Welcome back. All right, we'll bring you the latest here on earnings, reported quarterly results. The team from Wendy's had a strong day after reporting results, both a beat on top and bottom line. Some good news for Wendy's and some not as positive news for Wendy's. First, here in the U.S., the company's seeing a steep downturn, an 11% drop in same-store sales, but it's a much more optimistic picture when you expand to global ambitions for Wendy's. Globally record-breaking growth. They are in the midst of a turnaround strategy, and for Wendy's, that includes $4, $6, and $8 value menus. The company operates about 6,000 locations here in the U.S. and an additional 1,000 Wendy's restaurants around the world. Shares for Wendy's are down about 7% so far here in 2026. We'll take a look at a few notables. Valentine's Day edition. How can we not? We'll start with one of the world's largest chocolate makers and chocolate companies. That is Hershey's. A little red on the screen. Red may be appropriate for the holiday, but not what the company wants to see. Down 1.6%, but having a strong start to 2026. That includes a 9% pop in shares last week after reporting results. A few days ago, Barclays analysts raising its price target on the stock from $210 up to $240, maintaining their equal weight position. Shares of Hershey's are up 22% so far here, year to date. And finally, how about a look at Signet Jewelers, expected to get pop here for the holiday this weekend, up 0.8%. This includes brands like K Jewelers, Zales, as well as Jared. Shares are up 6% year to date and up 60% over the last 52 weeks. The average one-year price target on SIG sits at $113 a share, upside potential of another 25, 26% or so relative to these closing levels. All right, last week down here at the New York Stock Exchange, I spoke with financial content creator and good buddy of mine, Eric Pan, also known as Ericnomics across social media. We talked Bitcoin, we talked portfolio allocation, and we talked about all the ways to navigate market volatility. Take a look. How would you invest $1,000 right now?
Right now, we're seeing unprecedented times, right? We're seeing the AI trade, the debasement trade, precious metals are going to be going off the roof. So I would have a well-diversified portfolio, being a little bit cautious on the risk on assets. As we could see, it's very, very volatile right now as well, too. We previously thought that precious metals were a safe haven asset, but yet we saw gold and silver drop 30 and 10% on a single day, wiping out trillions of dollars in market cap. But I wouldn't fade the whole AI trade right now, too. We are expected to see more AI or more CapEx spending from the AI trades. So I would just go heavy on that while also having a diversified portfolio in other assets as well.
Eric, what is one habit that you have that makes you a smarter investor?
Absolutely. I think one of the best habits that I have right now, too, is just being very cognizant of what's coming in, what's going out, being very, very risk on and having conviction and deploying more capital whenever you do have that high conviction plays.
What is the biggest investing myth that you think too many people still believe?
I think probably timing the market is probably the biggest myth that most investors still believe as of right now, too. You can't ever time the markets. No one has a crystal ball, especially in this environment that we are right now, too. So just continue to deploy assets, continue to deploy cash, dollar cost average, and you'll be fine.
Not time in the markets, not time in the market.
That is correct. Yes.
Love that. One money mistake that you made early on in your investment career?
Probably the biggest money mistake that I've ever made in my earliest investing career was probably playing around too much with leverage and margin. I gotten burned plenty of times before too, and a lot of younger investors will also experience the same fate as well too. So be responsible, reduce your leverage, reduce your margin. Don't play around with fire too much unless you can afford to lose that money.
So we're really seeing the leverage play, especially on the crypto majors days, aren't we? Because it's all good, all well and good up until October 9th, and then after the 10th, it's that leverage starts to drag it down to the bottom hard.
Yeah, exactly. Right now too, and then we're still seeing some ripple effects on last Friday, where after the Fed chair nominee of Kevin Warsh, we're starting to see risk assets start to sell off in precious metals and digital assets, especially.
Do you have a take on Kevin Warsh? Was that your expected choice to replace Jerome Powell? What do you make of how the market reacted on Friday after we got that news?
Yeah, so I think it was pretty expected that Kevin Warsh was going to be the new Fed chair nominee. At least Polymarket had a pretty high odds for his candidacy, so I didn't expect anything else. Now, the markets wasn't too fond of that, especially the crypto markets, as we could see, right? Because Kevin Warsh has historically been known as being a little bit more hawkish, but with President Trump's nominee, I would imagine he'd probably be changing his tune a little bit more on that.
If you had to pick one asset class for the next 12 months, Eric, what would it be?
For the next 12 months, I would still stick with equities, but I would say 5-10 years, it would have to be crypto 100%.
Any specific crypto major you like over others?
Yeah, so I would stick with the blue chips. I'm talking about Bitcoin, Solana, and Ether. Altcoins outside of that is probably a little bit too much of a gamble, in my opinion.
Cash, crypto, stocks. How do you go about choosing your portfolio allocation?
Yep. So what I would say most average people, I would say probably 80% digital, 80% crypto. Sorry, I lied. 80% equities, 10% digital assets, and then 10% cash. Now, for the higher risk tolerant people, such as myself, I might have a little bit more of a higher allocation towards digital assets.
My man, you are always welcome. Eric Pan, where can people go if they want to find more of your stuff?
You can find me on all socials on Ericnomics, Instagram, TikTok, Twitter, everything like that as well, too. So, yeah.
Ericnomics, giddy up. Let's go. Thank you, brother. Nice to have
Thank you for having me.
Let's do it. Welcome back to the show. You're watching Taking Stock Friday, the 13th edition, live from the trading floor of the New York Stock Exchange. Time for a few fintech, crypto, and artificial intelligence headlines to send you into your long holiday weekend. First up, the crypto majors. Don't quite call it a bounce back because they've still been struggling for quite a bit, but they are at least green on the screen for this Friday. Bitcoin up 4%, ETH 5.6%, and Solana, the strongest performer, up about 9.5% at this hour. Next up, the CFTC forming a new innovation advisory committee, bringing together leaders from Polymarket, Robinhood, Ripple, many others as well, to help future-proof derivatives markets. It's what the CFTC chair, Michael Selig, calls the golden age of innovation. And finally, Layer Zero unveiling Zero. That's the name of it. It's a new Layer 1 blockchain backed by Citadel Securities, as well as the team from ARK Invest. NYSE parent Intercontinental Exchange is actively planning to examine how the network could support 24/7 trading. All right, let's bring in a man who has been here on the show before. We spoke with him at Money 2020 out in Las Vegas, Nevada, and it is terrific to welcome him back to Taking Stock. Scott Melker, host of the Wolf of All Streets podcast. Scott, welcome back as always. Can I get your take on crypto's recent performance? I don't mean these little bit of bounce back, Scott, but take a big picture from October to now. From your take, what's been going on?
Well, I think that we've seen a bit of a bear market in crypto, obviously, but I don't expect it to be the same kind of bear markets that we've seen in the past. I think that the idea of the 4-year cycle that many watch is largely broken at this point, and that this will end up proving to be more of a bull market retrace than a bear market itself when history looks back on it. You may remember actually in 2021, which is viewed as one of the biggest bull runs in the history of crypto. You had Bitcoin going up to $65,000 until April or May when China banned mining. And then Bitcoin retraced in a matter of weeks from 65,000 to 28,000, and then went back up to 69,000, and the rest of the market followed. That was a 55% retrace. We're not even that far down here. So when I look at price action like this, I think it looks like just another Tuesday for crypto volatility. I think that a lot of the reason that it's happened is because we have some anecdotal evidence that the large old whales who have been holding Bitcoin since it was $1 or lower have finally seen a price over $100,000 where they're very interested in selling. I've also heard from some of those people that the adoption by governments and institutions and the BlackRocks and JP Morgans isn't exactly what they signed up for when they got into Bitcoin with their libertarian values about freedom. And so they've been a bit disillusioned and have exited. But I think that's a much easier decision when you're worth $10 billion instead of $10. So it doesn't surprise me that we would see some of that. And the rest of it, I think, is just absorbing the fear that's in markets in general. So I'm not particularly concerned about Bitcoin in the crypto market at the moment. There could be more downside, but nothing really stops this train to the upside over time.
So Scott, I gotta say, I mean, we do crypto interviews here at the stock exchange every day. You're the first person I've talked to who says, yeah, you got these longtime whales, the longtime original, the OG hodlers, and they're saying it's institutional adoption that's sort of driving them away from the asset class, right? Like Bitcoin was cool years ago, and now that everyone's got some teeth in the game, it's not as cool. Is that essentially what you've been hearing?
That's essentially what I've been hearing, but I should say that I think it's patently nonsense. You can't believe that Bitcoin is going to become the global reserve asset, which, by the way, I'm not saying I do, but that was their early belief, was that they wanted to exit the financial system, that they did, you know, it was a hedge against inflation and poor monetary policy and the government, and that Bitcoin would eventually become the global reserve currency. Well, you can't become the global reserve currency without going through Wall Street and institutions and the government to get there. You can't replace the dollar by going around those institutions. As Lynn Alden has recently been saying, you can't become a multi-trillion-dollar asset just on the back of retail. So I think that that's what they believe. It doesn't mean that they're right. I also think there's just an element of those people with 10, 20, 50, 100,000 Bitcoin growing up, having families, wanting to actually live their lives and to enjoy them. And, you know, when you have a couple extra $1 billion, that's probably a lot easier. I do think that was the story of breaking down below 100,000. We've even seen wallets with 10, 20, 30,000 selling here in the 80s and 70,000. So I think largely that is what has happened here, and that selling has been stronger than even the demand from the ETFs and the digital asset treasury companies, and certainly from retail that's largely not participated in this bull market at all.
Scott, what will give you confidence to know if and when we do in fact hit so-called crypto winter?
I love a take from my friend Matt Hogan over at Bitwise, who says that we've effectively been in crypto winter since January of 2025, and crypto winters usually last 14 to 16 months. So most people are viewing the bear market, quote unquote, as having started in October, and largely with the mass liquidation event we saw in leverage exchanges on October 10th. But Matt points out the fact that retail has not really participated in this, and perhaps we've basically been in a winter outside of digital asset treasury bubble and the ETFs for the last year and a half. And we never really got the bull market that we were promised. Actually, when you look at the data and you kind of look at the market and the way it's behaved, that likely is the case. So I think that we've been in a crypto winter and that things are probably thawing right now. And even if you believe that we had a full cycle here, Bitcoin topped at 69,000 in the last cycle. We didn't even get a 2x on that. Previous cycles were 10, 15, 20x from the highs. So why would you anticipate a long, extended bear market that draws down 85% like those of the past? If we didn't get the upside, you can't believe that we're going to get the same kind of disproportionate downside. And once again, we've already gotten over 50%. I think it's enough. I think we've done it long enough. I think the most likely scenario, if you've seen us get to these points before, is that we chop sideways for a few months here before it starts to rise and belief comes back.
Scott Melker, friend of the show, host of the Wolf of All Streets podcast. Enjoy your long holiday weekend, Scott. Thanks for being here. Folks, don't go anywhere. Much more Taking Stock coming up on this Friday the 13th from the big board right after this. Welcome back to the show. This is Taking Stock on this Friday the 13th edition down here from the NYSE. Sumit Mehta joins us now. He is the CEO at Iris Acquisition Corp, which just rang the closing bell down here on the trading floor of the New York Stock Exchange. Nice to have you here. Thanks for joining the show.
Thank you for joining. Thank you. Thank you for letting me in.
Of course. Can I get your experience ringing the bell? What was it like? It's been a wild week here on Wall Street. We've been looking forward to Friday's closing bell for quite some time.
So it's of course been a very, very prestigious event for us. The experience has been great. Closing bell on the New York Stock Exchange, which is such a historic trading floor, really makes us bring something out of box, and it was really a dream come true.
Seems like, Sumit, there is a little bit of a renewed conversation on SPACs. Talk to me about your own background in SPACs and learned lessons having been through this process before that now you hope to really roll out here once again.
Yeah, that's a very good question. So actually, about 5 years back, when I got to know about the SPAC product, it really intrigued me because SPAC as a product is a very structured product to bring emerging growth companies to the market, right? So our first SPAC experience was very challenging. We had a lot of learning curves, but we were able to close a successful deal with Pipe in it. And I think that kind of gave us the confidence to come back in the market and raise a $150 million SPAC. I think emerging growth companies ranging between $500 million to $5 billion in market cap, they have no option but to tap the public markets to a SPAC product. And it can actually make them public at a faster pace and at a lower cost.
Being based in Dubai, talk to me about some of the ways that you are viewing specifically global demand for assets right here in the United States. And what does that look like for U.S. investors that may not know very much about the investing landscape in other markets?
Sure. I think, last 5-10 years, Dubai is sitting in a very, very important landscape in terms of crossroads. So capital is always fluid, but if you are sitting in a city like Dubai, which kind of attracts the east to the west, I think there's enough demand for high growth assets as well as more stable assets. Also, if we see the maths, the last 20 years, returns have come in markets like US, and it continues to attract global investors. Sitting in Dubai, we have access to institutional family offices, sovereign wealth funds. They all have a large exposure to US growth markets. And I think, again, SPAC as a product, they can participate in that growth.
That's amazing. Congratulations on all the success, for listing down here at the iconic New York Stock Exchange, and for ringing the closing bell. It's really good to have you.
Thank you very much. Thank you very much.
Come back anytime. Sumit Mehta, CEO at Iris Acquisition Corp. Don't go anywhere. Much more Taking Stock coming up after this, including the latest from Money 2020's own Scarlett Sieber. More Taking Stock coming up.
Welcome back. I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, where we break down those finance buzzwords you see on a crowded subway but might not actually know what they mean. Today's term, CBDC, sounds like a wellness trend, but it's actually the future of money. Central bank digital currency. Here's the tea, people. Government saw crypto blowing up and said, wait, people are trading Dogecoin while we're still printing paper? Not on our watch. Enter CBDCs, digital versions of your country's currency backed by the central bank. Think of it like this. If Bitcoin is the rebellious teenager, and we all know who those people are, CBDC is the straight A student with government approval. It's not decentralized like crypto. It's centralized, regulated, and basically the digital twin of your dollar, euro, or yen. Why does this matter? Two big reasons. Speed. CBDCs make payments faster than your ex ghosting you. No waiting days for transfers, instant settlements. And secondly, control. Governments can track transactions in real time. Great for fighting fraud, but also, hello, privacy debates. So next time you hear about CBDCs, remember, it's not Bitcoin, it's not Venmo, it's your government sliding into that digital age. And that is your jargon translated. Back over to you.
Final tail of the tape on this Friday, February 13th. The S&P 500 finishing in positive territory, 0.05%. The Dow 30 up 0.1%, and the small caps the best of the bunch on this Friday, up 1.2%. Sets the stage rather for an incredibly busy week on Wall Street. We are, of course, off on Monday for the President's Day holiday. On Tuesday, we'll get quarterly results from some of the home builders, including Toll Brothers. We'll also hear from Palo Alto Networks on that day. Wednesday, earnings from Figma, DoorDash, as well as Carvana. A few great NYSE listed brands right there. Thursday of next week is a big one. We'll hear the latest results from the team at Walmart, as well as John Deere and Company. And this day next week on Friday, it's a big one. Not just Q4 GDP print, but also the PCE inflation print. Thanks for watching Taking Stock today and all week long. Enjoy the President's Day holiday. We'll see you again on Tuesday. Woo!